back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch Gaddy, and in today's ROCast, we're speaking with Andrew Mitchell, one of the founders at Ophir Asset Management. And Andrew, alongside Stephen Yang and other colleagues, manage 4 funds. Ophir has a fundamental bottom-up research approach aimed at identifying businesses domestically and internationally with the ability to meaningfully grow and compound earnings over time. To put it another way, they want to find new companies before they end up in Vogue. For me, I really enjoyed delving into the process of the how, in particular, how they go about trying to first discover a new business before it gets into Vogue. Andrew unpacks Transmedics and Life 360 plus others and discusses their process, which enabled them to be confident enough to commence buying into these businesses before their good old friend, Mr. Market. Also, before we get into this conversation, let me put to you a question which Andrew put to me. How long does it take to make 10 times your money compounding at 22% per annum? If you have the answer, you're pretty good at maths. But if you don't have it, don't worry. Andrew is going to dig into the answer and explain why this number is an exciting number for them. So before we get into this podcast, please remember this podcast is intended for entertainment purposes only and should not be construed as any form of financial advice. Be sure to listen to the disclaimer at the end of this podcast and to keep your feedback coming. You can reach me at mgatty@ywm.com.au. So with that being said, I hope you find this conversation enjoyable as much as I did. So sit back, relax, and enjoy. Andrew Mitchell, Ophir Asset Management. Welcome to the Rate of Change with York Wealth Management.
Well, thanks very much for having me, Murdoch.
Mate, good to be here. Good to actually finally meet you. I haven't actually met you, and I've known you for years, probably about a decade and a bit.
I've seen you on a Zoom, on the other end of a Zoom, many times before.
Many times.
I feel like I have met you before, but I think it's just been all the Zoom calls with you.
This is the benefit of Stalkbook. Every single social media these days.
You're a lot better looking in real life. That's the only.
You've got the glasses. Anyway, Andrew, good to be sitting here in your offices. Why don't we, for people that don't know you, why don't we kick things off and tell everyone a little bit about yourself and how you got into this beautiful world of financial markets?
Yeah, Andrew Mitchell. When people ask me this question, I've obviously listened to many podcasts in my life, and everyone seems to have this fantastic story about their grandfather taking their hand and walking them down to the stock market and sitting in the corner and watching the tickers roll over and just becoming hooked. I don't have that story. For me, I was just like any other kid, looked up to their father. My father worked for the government. He was an economist. And so I just wanted to be like my dad. And so I studied finance and economics at university and went and worked at Federal or Commonwealth Department of the Treasury when Peter Costello was the treasurer, and did things like forecasting international economies for the Treasury forecasts. And through that, I went to Commonwealth Bank as an economist, and I got into equities research at ComSec when they had an institutional equities research team. Met David Paradise through that and had been doing that for a very short time, and then became a fund manager at Paradise Investment Management. And in 2012, went out with Stephen Ng and myself, and we both went out and obviously went out with myself, and we started Ophir Asset Management. And that's the quick story of how I'm here.
The quick story, there's an article in the AFR, 2 young guys giving it a go, and here we are today.
Yeah, I was 32, I'm 45 now, so yeah, it's many years. And the great thing and about that story, Murdoch, is that we invested all our money in the funds when we started, and that's compounded. I'll ask you this question. How long does it take to make 10 times your money, compounding at 22% per annum?
Well, I know, what is it, 7% for 7% over 10 years gets 100%. So what's the answer to the question?
Well, the answer is 11 years and 8 months. And the reason I know that is because we have just made, in the month of March, 10 times the money for our original investors in our original Ophir Opportunities Fund, who invested right at the start, 10 times. And we've done 22% after all fees per annum in that original fund for now, 11 years. And I was just counting back from August. What are we, where we are now?
So if anyone's wondering why I wanted to get Andrew on the podcast, you may have an idea, just to kind of throw that out there. But look, for people that don't know Ophir and, besides those numbers, who is Ophir? What do you do? And what's the investment philosophy?
Maybe I'll start with where Ophir. I didn't come up with the name Ophir. It was Stephen. We had some really terrible names. Stephen wanted Pursuit Capital. I was like,
sounds like Prosciutto Capital.
It sounds like Trivial Pursuit Capital. It's a horrible name. And I told him, no, go away. Let's research famous things that happen in history. But let's also think about what we're doing. And we said, you know what? We're looking for gold nuggets, and we're looking, be the first to find it. And so we said, okay, well, let's have a look at the gold rush. What happened around the gold rush? Well, in 1851, in a little place just outside of Orange in New South Wales, some gentleman I do not know the name of found gold, and that led to the gold rush. So Ophir, or Ophir as it's called in New South Wales, was the place where that first gold was found. And we are small cap investors. We want to be the first to find that gold nugget, because you read about the stories of the goldfields, and my mother's family, and my mum is from Ballarat, so I grew up learning about them. It's the first guys to the goldfields that make all the money, and then the people who come at the end, they have to be very lucky to make money, because the first people are the ones that clear out all the easy gold.
And the people that make a lot of money is the people sell you the tools to go
scavenge. The shovels. The picks and shovels.
The shovels. Don't forget about those boys.
Yeah, exactly. The picks and shovels. They're maybe a bit smarter than us. We want to be the first to that's maybe Bloomberg.
Yeah.
that make all the money, as you know.
Well, without the potential sniff of gold, you wouldn't have an industry.
Yeah, exactly.
So speaking of industry, 4 funds, right?
Yep, that's correct.
So why don't we just quickly knock that out? So what are the 4 funds? What do you cover? And how much money are in the funds? What's under management these days?
Right. We've got a few billion under management, but it's broken into, as you said, Murdoch, 4 funds. The Ophir Opportunities Fund, that is the original fund. It's been going for just under 12 years. It's done 22% per annum after all fees. And obviously there's some significant outperformance there. So there's been quite a bit of performance fees taken out. That I think is outperformed by 14%, something like that per annum. Then we had our second fund. Now, this is the High Conviction Fund. It has around a 40% overlap with the Opportunities Fund, which is a small cap fund. Now, the High Conviction Fund has less stocks, 30 stocks. It's still Australia and New Zealand. 25% is actually in the top 100. 75% are the bigger small caps. That fund is listed on the ASX. It is a listed investment trust, and it trades under the ticker OPH. And I think is trading at a 10% discount at the moment, which we think is pretty good value, because we've seen it before when it trades at a 20% premium. And generally, LICs, they trade on discounts when asset prices are low, because Mr. Market is fearful, and they trade on premiums when your taxi driver is telling you how they're buying Bitcoin and all the different stocks in the share market. And so when things get frothy again, we'd be expecting that to go from a discount to a premium, and obviously the unit price to go up. So that's ticker OPH, our High Conviction Fund. Now, then we have 2 global funds. So these have a lot of overlap. We're talking 80% plus overlap. The Global Opportunities and the Global High Conviction. The difference is the global high conviction has 30 stocks, the global opportunities has 35 to 40. Now, with these two funds, they invest in the Western world. So global funds, 60% is the US, 7% is the UK, 20% is Western Europe, 3% is Canada. This is very rough. You got 2% Australia. We don't have any Australian investments, and around 10% is Japan. We don't have any Japanese investments. So we're investing really in US, UK, and Western Europe and Canada. And that fund's been running for that global high conviction fund's been running, and global opportunities been running since 2018, I think, maybe a bit earlier. And I think so. Just be careful when look on our website and check these numbers, because I could very well get them wrong. But we've done something like 14, 15% per annum for 6-7 years versus the index, which has done something like 8%. As I said, go to our website and check those numbers are right. Don't make an investment on those numbers. But that's what I think the performance has been for those.
Well, why don't we kick straight into macro first, and then we'll get into, how you look at for companies. And the reason I want to get into that is 2 nights ago now we had the Fed come out, put the rate range on hold, signal that they're going to I believe the exact language, they're not going to increase rates by the back end of the year because their inflation's the economy is doing well, right? And we've seen equities.
I don't see any stag or any inflation.
Yeah, it's weird.
I
love statements that don't mean anything, and then all it means is essentially the market didn't get sold off dramatically. And why this is interesting is, would you say that it kind of feels like global markets are running a two-stage economy? You have a number of companies that are all uplifted, absolutely hammering, associated with AI. And then you got companies like Google, Microsoft coming out saying that we're going to invest more in this space. And then essentially, the picks and shovels, as I was saying before, are all kind of getting dragged along. There's that happening. But on the other side of things, there's a whole lot of businesses that can't catch a bid. But wouldn't you agree, they're probably looking healthier than they've looked since COVID times, because they've tightened the belt, fired everyone, really reduced. And there's businesses out there that, from a value investing perspective, look fabulous. And it's kind of not traveling that particular direction. Would you agree with that? And the reason where I was going with this was, I remember you put out a chart where you showed the Russell. Like, if you literally followed and made investments based on how the Fed was going with the 10-year bond rate, it pretty much mimicked how the Russell was performing.
Yeah. I don't remember that chart, but yeah, that is the I put out. We do a lot of charts. So so the question is there opportunity in terms of value elsewhere in the market outside of the AI and those things? Yeah. So I guess you have a look at the factors that are working the greatest. Momentum is working very well, and if you're in AI or obesity drugs, electrification, those thematics, well, you're going to have done a lot of work to have not made a lot of money, because that is where the momentum is. Now, obviously, you look at the big 7 and maybe big 6 if you take out Tesla, there's huge amount of momentum there. They're driving the whole share market higher, and that capital is coming out of small caps, less so mid caps, and less so other large caps, but still coming out of those. When it comes out of small caps, maybe it's not in quantums actually more, but when it comes out of small caps, it sends their share prices lower because everyone's chasing the momentum, and small caps have less liquidity. What that has meant is that small caps in the US, and that's when Murdoch was just saying the Russell, so that's US small caps, the Russell or US small caps are trading on some metrics at the cheapest level compared to large caps in the US than they have since the dot-com bubble. And that is just that bifurcation of the market. The large cap, big winners. The large cap S&P 500 is trading, I think, at 23, 24 times PE versus its historic average of 18, whereas small caps are trading at 15, 16. But then if you go to the smaller end of small caps, where we sort of operate, say the 2, 3, 4, 5, 6 US billion-dollar small caps, they're still top 100 Aussie companies. they've underperformed again the bigger US small cap companies. So if liquidity is what's driving this, because interest rates have gone higher, money's come out of the market and it's gone into these bigger companies, and you're taking a view that inflation, and you listen to what Powell said, that inflation is under control and the next interest rate move is more likely to be down than up, liquidity comes into the market, where is it going to flow when interest rates actually go down? Well, I can tell you what happened in 1973, 74. So for people listening to this, in 73, 74, you had a similar recession to the one you're having now. OPEC cut production and oil price soared, and it created inflation spiraling out of control right around the world. The Fed raised rates to try and get a hold of the inflation, and small caps were hit for six. So too were growth companies, similar to what's happened in the last couple of years. But in the end of 74, so in December 74, the Fed went, right, enough's enough, we're cutting rates. US small caps put on 420% over the next 5 years return after falling 50, 60%. It was the best performing sector of the US share market for 5 years running. Liquidity flowed back, and small caps went from being massively undervalued to massively overvalued. Now, I don't know if they're going to become massively overvalued in 5 years' time, but I do believe in mean reversion, and on every metric, they are undervalued at the moment. And so if you want to be the first to the gold nugget and you believe, I don't think going out there and putting your incremental dollar into an AI mega cap, you are going to be the first person on the gold field who's picking up the dollar bills, or they're picking up the easy gold. You're the person who's probably starting to sell to the smarter investors. So how am I dealing with this? And I'll just finish with this. I have a direct debit every month going straight into our global high conviction fund. My bank account, bang, money goes in and then it goes out and goes into the high conviction fund. I don't know when it's going to turn. Inflation is stubborn above 3% at the moment. So, the amount of rate cuts that we've been expecting, this year, next year, they're getting pushed out, all that for granted. I don't think it's a question of if, though, it's just when. And for the patient investor, there's a lot of money to be made in US and global small caps at some point in time.
So now we've set the scene, or, framed the picture, so to speak. When you look at essentially, putting the paintbrush to the canvas, what's the process? Like, what I love about investing is, as you said correctly, like if you want something to happen tomorrow because you've made a decision, the probability of that happening is not going to happen. Nearly 9 times out of 10. But as you're saying, if you go find companies that meet essentially what you're looking for, and then you back them at the right time, and then you're patient with them, then essentially, it comes through. So what is Ophir's process to go find, the next gold nugget?
The process is, it's complicated because there's not like some straight formula. There's a lot of people at Ophir. I wish it was simple and to say it's just myself and Stephen, but no, there's quite a big investment team here. There's in excess of 10 people, and we all have our different methods of going out and finding that idea. Some people are reading newsletters, other people are speaking to other fund managers, others are speaking to brokers, newspapers. Doesn't matter. We get the idea. But an idea is just an idea. Like that doesn't make an investment. How do you get the conviction to put an idea into the fund and think, right, this is how we're going to make money? So we need to get an information edge to do that. And so how are we going to generate an information edge? Well, we need to be clever. Well, one thing, let's work out what the market knows. So speak to the brokers, speak to other fund managers and know where they're at. But the next thing is, and there's many different ways to do this, you've got to go out there and you've got to find the data, find the person who works at the competitor, all the different people who are in the ecosystem that will let you work out whether this company is going to do very well or not so well over the next 1, 2, 5, 10 years. And so that's basically how it, from a top level, how it works.
It's interesting you say that. I remember someone telling me this a while ago. When you're trying to find companies that people don't know about or new products coming out, as you said, you go speak to the industry. And like say medical's fascinating because there's things coming out all the time. And one thing someone said is you go to a particular event where the doctors are, right? And you go up, you just chat to doctors, have a chat. Oh, have you heard about this one? Maybe it was even you said, I can't remember. But have you heard about this particular
this
product?
was me, Matt.
Maybe it was you. Like, you tell the story, right? You tell the story, but there's essentially.
Okay, I'll tell you the story. There's a company, Transmedics, one we've owned for several years and done very well out of. And we did exactly that. There was a conference where, so Transmedics, for people who don't know, and I imagine most people won't know what it does, is it's involved in the removal, storage, and transportation of hearts, lungs, and livers used for transplants. So there's a huge conference once a year in the US where all the transplant surgeons attend. Well, not all of them, but a lot of them, they go. It's a big junket. And we just rocked up and we spoke to as many of these doctors, but also other companies that are in the ecosystem. And we asked them about Transmedics. And what we got was, one, the market's numbers for Transmedics about the number of heart transplants that were going to occur in this year was going in the US was undercooked, massively undercooked. And the reason was because Transmedics was growing the market. So because Transmedics is a lot more has a lot better system, a lot more hearts actually when you're competing against an ice cooler, a lot more hearts are actually making it to a recipient's body. And so we could see that the market was underestimating how this Transmedics was going to go. But also how warmly the surgeons spoke about Transmedics and what it was doing for their business. And the great thing about, one thing I can tell anyone, this probably doesn't surprise anyone, but in the US healthcare market, it's follow the money. And so the one thing about Transmedics is the patient's happy. Well, they got a new heart, so that might not have made it that far. The doctor's happy because they're not up in the middle of the night performing this emergency surgery and having to remove this organ. The patient goes into surgery at, 10 a.m., 11 a.m. at a really good time. But also the doctors are now doing more, and so they're making more money. Furthermore, the hospitals are making money because they make money every time one of these transplants happens, and Transmedics is growing the industry. And finally, the insurers are making more money because it's a lot cheaper for them, believe it or not, to get someone a heart than it is to have them going in and out of hospital and on medication and in ICU and out of ICU and all those sort of things that go with these terrible ailments. So what we learned very quickly, walking the floor of this big conference, was everyone wants Transmedics to succeed. And that's a pretty good way. Normally there's someone trying to block and tackle a business. If there's a competitor, well, the Yeti ice cooler is your number one competitor, right? Like, so there's
Don't get me started on Yeti ice coolers. Like, everyone loves them. They're expensive, but they don't have any bloody wheels, and they're massive. It just makes no sense.
It's a listed company in the US. We know it well, and I don't think it's done too well recently. So you might need to.
Everyone loves a Yeti, but can we just have some wheels, please? Back on the Transmedics. The one thing I find fascinating is, do you mind giving a bit of color around the statistics about how much organ loss there was? And then with the use of what they're doing right now, how much they've actually been able to reuse and save, like they would have not made it, dead on arrival.
Yeah, so I'll need to maybe brush up on all these statistics, but I think lungs, 80% of lungs don't make it to a recipient being removed, and I think it's 50 to 60% of hearts. So Transmedics is obviously improving this dramatically, and that is what is growing the market in the US. And you can actually plot how many heart transplants, lungs aren't so big, how many heart and livers that Transmedics is doing. And the amazing thing about this business is you can see that they're actually growing the US market, because the amount of hearts they're doing is basically maps out. You look at the last 20 years, how many extra hearts were getting transplanted a year, and then Transmedics hits the market and it's just jumped up massively. And that is the amount that Transmedics are effectively doing. So yeah, it's good to, this is a great thing about my job. And we're talking about a company here, but every company we look at is fascinating, and they're solving real world problems with some very, very smart people mixed with some very smart entrepreneurs, and they're solving world problems. And the beauty, if you're listening to this podcast, I'm sure you believe in capitalism. I certainly do. And I'm looking at the world we live in now and just where we were when I was here 30 years ago, when I was 10 years old. And it's just amazing the leaps and bounds that we're doing, and just to be able to allocate capital and get to meet these people that are actually changing the world is fantastic. And Transmedics is one of those.
It's a really interesting story. What else are you seeing these days? What other... Have you also got? Oh, that's a silly question. Why don't you give a couple of?
That's why I stay
here for the next 4 hours. But what else is something quite interesting that comes to mind? A company that you're following, or something that you're about to?
Well, there's a lot of companies always, and there's, I'm in the minutia, but to sort of take myself out of that and look at what companies people listening might find interesting. In our Aussie funds, we have a business called Life 360. It's actually a US business. For those who don't know what it is a family safety app, globally leading family safety app. It enables you to see where loved ones are, see that they're safe, all via an app. I'll give you an example, sort of thing it does. If you have a 15-year-old, that's too young, 16, 17-year-old son or daughter who's just started driving, and they're speeding or they're on their mobile phone when they're driving, as a parent, you'll get an alert. Likewise, if they were to start wagging school and leaving at lunchtime, unless they're leaving their phone in their locker, you'll get an alert that your kid is leaving school. But maybe more from a safety aspect, your son or daughter has left school, they're 11 years old, they've got a phone, you'll get an alert that they've left at this time and they've come back and they've got to school at this time, and those sort of things. And they've got home, after leaving school at 3:30, they got home at 4, all that sort of stuff. So you really can see where your loved ones are. Why do we like this business? Well, it's been a bit of a roller coaster of a ride, but we've always believed that this is a platform business. When I say platform, it is actually going to be an amalgamation of many businesses running from the platform of these huge amount of customers that have one thing in common. They really care about the safety of their loved ones. And they just announced in February that they're going to launch advertising. So for your listeners, what does Ophir do when we hear that? Well, we need to work out how much they're going to make for advertising. So they've disclosed that they're going to make $5 to $10 million, they think, this year from advertising. Our view is this is likely going to be a conservative number. Why would they go out there with a big number when they actually don't know at this point in time? So we all become problem solvers. We put our hats on and we go and try and work it out. So I went through all their presentations first thing, and you can see they've got 65 million users around the world, monthly users, but they have around 25 million daily active users. And there's a slide in one of the packs that says, and those daily users use the app 5 times a day. They're checking, it's probably a worried mum or dad, checking not so much the kids, checking where their parents are, but I know that that's the fact. It's actually the parents that are using it so much. They are generating, on my calculation, around 50 billion to 100 billion impressions a year where people are getting on that app. Now, so if you have advertising, you're generating a banner. They're putting a banner ad on this app. So what did I do, Murdoch? All right, I'm trying to get to the interesting point. We have to be faster than the market, and we have to work this out. We've gone and spoken to all the top brokers. Digital advertising is a sector in itself in the US. Think Snapchat, recently IPO, Reddit, not Duolingo so much, but you can put that in there. Duolingo, Pinterest. So it's a big market. Let's go and speak to all these analysts, and I'm going to sit down. We actually pay some of these places quite a bit of money. So they sat down with me and they found it really interesting. And we problem solve. People who have looked at this market for years. And the conclusion that everyone's getting to, and so your listeners are going to hear this before other people in the market do, is that they should be earning over $1 to $2 initially per 1,000 impressions. But ultimately, they should be getting somewhere between $3 to $5 per impression. Now, if the numbers become really big on this very quickly. And given advertising should be a 70% plus margin business, this has the ability to absolutely just skyrocket their earnings if it comes through like we expect. So the reason we were able to get that edge was moving faster than everyone else. Now there's a couple of analysts in the last week or two, so they're months behind us, are starting to do this similar work. Does that worry us? No, the share price is going up. It's up a lot last month, the month before that. We know that we're a couple of iterations. We've done some far more clever work than that now in terms of this whole business as we've extended this. And so we're a couple of iterations in front of the market in terms of our knowledge on the business. And, it's got to the point where we're saying, hey, there is a chance, and you can certainly point a picture where they end up with 150 million active users. They're making something like $250 million of EBITDA from their subscription business that they currently have. But from their advertising business, they're making something like $400 million of EBITDA. And so that's $650 million of EBITDA US or $1 billion Aussie. Put that on 25 times EBITDA multiple, and you've got a $25 billion business or $30 billion business, and it's currently a $3 billion market cap. Now, what time frame to get there? Maybe it's 10 years, maybe it's faster, it's 6 to 7. Either way, we can see that this business, if they do execute really well and it plays out like we think it can, there's a big chance that this is going to make multiple times the money. There's also a chance that we're going to be wrong, and we do get these
Just a simple question, devil's advocate. I haven't looked into this company. Isn't this feature like inbuilt on most Androids and Apple phones? Like, find my phone, or is this like
not find my family's phones?
Find my family's phones. Right. No, that's not. I'm just curious. As in, like,
no. So, I could talk about this company for a long time, and
It was just one question I had. I said, you know how like everyone goes like companies, what's the mode?
There's find my friends. So the biggest risk this business has, and it's an existential risk, is that Apple launches its own app that does this. The Find My Phone that's finding your phone. It's not finding where you.
Find my phone, or like like my wife's phone on an Android. Find my wife's phone, like it just pops up that it's in coming down the highway. But doesn't, as you're saying, it doesn't say the speed or.
Yeah, this is a freemium, so you don't pay for this. This app does, like so much more than all of this, and so that's a very elementary app. This app is way better, and they're growing. It's free, so you're not paying for it. So basically, they've got a subscription where you get all the bells and whistles, or you get the freemium version, which just has a banner ad, and that's all you're paying. Is that there's an ad that's in there that you probably don't even notice.
If it's free,
you do notice.
If it's free, it becomes the client.
Yeah, and so
the product.
So yes,
becomes the
yes, it might be inbuilt into the phone, but they're growing the number of subscribers.
It's a high probability Apple probably buy them or something like that down the track.
I don't think Apple would buy them. Apple iOS makes a huge amount of money just from their app store, so they're getting a chunk of every subscription business regardless. So they effectively do own,
what's the margins there? Is it 30% or something like that? Google and Apple get from if you.
Yeah.
Oh, that's something crazy.
That's right. Yeah.
So they're getting it regardless.
So they're getting it regardless. Yeah. But this is all we're getting a huge conversation here because with the game Fortnite, this is all in the courts in the US at the moment. And Life 360 is in the courts as well. They're not in the courts, but they're getting spoken about with Apple because Life 360 owns a business which is called Tile. And if you know the Apple, what do you call them? The tags, they're what do you call them? No, it's not an eye, calling an eye tag, but the Apple tags, so that you put them around your key ring so you know where
the trackers.
Yeah, the
tiles. Yeah, fine. Like 60 keys. Yeah.
Tile is owned by Life 360, right?
Is that really? That's fantastic.
But and so it integrates into your app, so you can see where your where your keys are and all those sort of things. But Apple is being mentioned not by Life 360 about their anti-competitive behavior and what they're doing against Tile. So Apple is in the existential risk. Apple is in the courts at the moment about their anti-competitive behavior.
Yeah,
if they did come and launch a complete competing product and all that, this is not the time to go and do that, is our view. But it is an existential risk. Apple doesn't have too many of these other than their Apple Music, the Spotify competitor. It doesn't have too many of these sort of style apps or anything that's out of stuff that should look like it belongs on the phone. Anyway, I could talk about it for a lot, but it's a platform business. They have 60 million users. We think going to 150. As I said, you can paint a picture where you get a $25, $30 billion valuation. Is that going to happen? No, but even if half of that came true, everyone's going to be very happy. There's a lot of margin for error on this business that if they don't do so well, we can still make good money, and they probably won't get to that 10 times. Chances they won't get that, but if they get anywhere near it in the middle, it's such a big gap to drive that you can drive through. They'll make more acquisitions. We've got an idea of what they'll buy next, and they'll be very accretive. And this is a platform, and you get to monetize these 150 million people by selling them things that link in with family safety. And I know when I flick on the news in Australia or in the US, there's a lot of school shootings, and they aren't quietening down. And there's a lot of terrible stuff that happens in America, their biggest market especially, and Australia's a big market for them too. I think that this is only going to be, the consciousness is only going to increase, and the need for these sort of things is only going to increase over time. The final thing I'll just say, which this is actually just straight out of the presentation pack, but nobody talks about it, and it's huge in what it means. Their fastest growing state is Texas, and they're saying they're states in America which are the most penetrated are the fastest growing. So it's not really network effects, but it's sort of, like it's a barbecue. You're going around and one friend's on Life 360 and another friend's on Life 360. So you get on because you're hearing it. So as it's growing, it's actually accelerating the growth. So where the states where they have the least penetration, that's where they've got the lowest growth. But in Texas, 20% of people in Texas have got Life 360 on their phones. And that's the fastest growing state. So that's telling you that as you hit these, it's got an adoption curve, which has got that asymptotic shape. It's in the presentation. You can just see this, but I haven't heard anyone talk about it. I think that that's sort of something as well. It's
just funny you mentioned Tile, because I'm just thinking all the great products you mentioned Fortnite, you mentioned Tile, you mentioned, lightly these drugs. It's kind of like you see a mate using them about 12 months ago. Oh, that's really cool. And you kind of forget about it. Then all of a sudden it just kind of pops up in the market somewhere. And you're like, I wish I paid more attention to that at the time. But that Tile business is brilliant. It's genius.
Well, they bought Tile and they've lost it. They've dusted a lot of money on it because I think they would have been able to buy it a lot cheaper. But it's worth a lot more to them than it is as a standalone, because it's something that it works well with their app, that you can see where your things are. I know I've got my car. I've got a Tile just in my car at home, so when I go and park in the shopping centre, I can find where my car is by using the Tile app.
It is a beautiful rainy Friday afternoon here in Sydney. But just before we finish up for the day, we were discussing in the beginning the two-speed economy and good quality companies, value stocks that haven't been found, are taking a bit to get up and going again. We've currently seen what the IPO and there's a lot of brokers out there doing capital raisings that made a lot of money a couple of years ago and it's dried up a little bit. What do you think is needed to get the small cap side of the market really hammering again?
Oh, I think I said it before. It's interest rates. So we need to see interest rate expectations go down. Well, actually, let's take it a step back. We need to see inflation in the US start going below 3%. As at what's happening in the moment, Fed raised rates, holding rates, and inflation is bouncing around just above 3%. We need to see inflation that the financial conditions are at this point tight enough, restrictive enough that inflation starts coming under control and starts trending below 3 towards 2. Interest rate expectations come down, and then effectively, if the Fed will cut rates. When the Fed cuts rates and interest rates go down, more money will flow into small caps. Just like when it goes out, they're the ones that get hammered the most because they're less liquid. When it comes in, they go up the most, and they're trading well below their historic average in terms of their valuations. And so any return to their historic valuation will give a lot of alpha.
And finally, what keeps you up at night and what gets you out of bed in the morning?
What keeps me up at night and gets me out, like work just gets me out of bed. It gets me out of bed in the morning. I'm excited to go to work every single day. I find my job incredibly fascinating. What keeps me up at night? Keeps me up. I sleep pretty well. I focus on, this is not really the question you're asking, but I go to bed at 9 p.m. every night and I go straight to sleep. Sleep is so important for me, and I get between 8 and 8.5 hours sleep a night. And I think that's very important to have your mind functioning. You need to be putting the right food into your body, but also be getting that sleep. So nothing keeps me up at night, if that makes sense.
I couldn't agree more. Ever since I started crashing out at 9 and going on the carnivore diet and eating less like crap, you feel so much better and you feel like you're in your mid-20s again.
Yeah, and you have clarity of thought.
Start aching and all that type of stuff, and you just function so much better. Advocate for it. Well, Andrew, it's great having you on. If anyone wants to learn more about Ophir, or where should they go? What's the website?
Just go to the website. Just Google Ophir, which is spelled OPHIR, and our website is Ophir Asset Management.com. And there'll be a lot of stuff there to read, and you can just reach out to us at any time or follow us on LinkedIn, anything like that.
Fantastic. Andrew, great having you on, and speak to you soon.
Thanks for having me, Murdoch.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.